What's going on, Eddie? We are back with another good topic. Man, last time we talked about what it takes to qualify. You went over limits, ratios, all that good stuff for people who are looking to get in the marketplace and buy. Today, we just want to continue that series with another product, which is the conventional loan. So without further ado, Eddie, thanks for joining. What is a conventional loan and how is it different from what FHA loan product?
There's many different aspects to FHA government loans versus conventional, but the primary differences from a buying standpoint are your typical run-of-the-mill loan. A conventional loan for a first-time buyer will afford you the ability to put as little as 3% down. An FHA loan, it will give you the ability to put as little as 3.5% down. With an FHA loan, you don't have to be a first-time home buyer to get that minimal down payment option of 3.5% down. With most conventional products, you will have to meet the definition of a first-time home buyer in order to get 3% down. Otherwise, your minimal down payment option is generally going to be about 5% down. First-time home buyer, that definition can be a bit confusing because it doesn't mean that you have never owned a home before. By definition, it just means that you have not been titled to a home in the last 3 years. So as long as your name has not been on the title of any real estate in the last 3 years, then you meet the definition of first-time home buyer. There's a few different aspects of a conventional loan. Ratios, your DTI ratios are going to be a bit more restrictive than they would on your FHA loans. An FHA loan will give you a back-end debt-to-income ratio of up to 56%. Conventional, you're typically going to be capped anywhere from 45 to 50%. People that are more restricted on their DTI gravitate to an FHA loan. A conventional loan, if you are putting less than 20% down, you're generally going to have monthly MI, where an FHA loan, if you are putting anything less than 10% down, you are going to have both your upfront MI as well as your monthly MI. If you put down 10% or more on an FHA loan, you are going to have that monthly MI for only 11 years and then it will fall off. With a conventional loan, regardless of how much money you put down, if you start with MI, once you have achieved roughly 20 to 21% equity, your MI will cease. MI on a conventional loan is credit-based, meaning the higher your credit score, the lower charge or cost for your MI. With an FHA loan, regardless of your credit, you're going to have a fixed monthly MI rate.
You covered quite a bit of ground there. One thing that popped out that I think a lot of people should know, or two things rather, the fact that if you weren't titled, which is very important to understand, title means just your name being on title documents, deeds, saying that you are an owner of a real estate. A lot of people don't know that. I don't think that maybe for whatever reason they have sold their house and they've been renting for X amount of years that meet that threshold of 3 years, you're not qualified for first-time home buyer incentive using this product, which is a big deal. And secondly, the myth that a lot of people will ask this question is, man, for a conventional loan, I gotta put down 20%. And that's not accurate. A buyer should know is you have as low as 3% on a conventional product, but the difference that you should know, I just wanted to highlight this, make sure people understood and know that conventional loan, how much you put down determines your mortgage insurance and how that works, as well as if you're going to be paying it the moment you receive the loan. If you do 20% down, then you miss that mortgage insurance altogether, or the waiting period for equity to allow that to fall off, which is a benefit. And I think some people experienced that quicker during the COVID era when home prices just shot up. Right. Now, it might not necessarily be the case so quickly, but there's an option of that being removed. That was two things I took from that I want people to take with them.
And that's a good point you touch on, the 20% down payment myth. I think that may have derived from a mixture of people not wanting to pay MI and kind of mixing those two things. It's kind of like playing that game of telephone where the message starts out a certain way. It was probably conveyed close to correct. And then once you pass it through 2 or 3 people, it turns into a completely different message. Generally speaking, on a conventional loan, if you're putting down less than 20%, you're going to have MI, which is probably why a lot of people then converted that message to, well, I have to put 20% down on a conventional loan, which isn't the case at all. You can put down as little as 5% as long as you fit within the DTI thresholds. And if you have not been on the title of a home in the last 3 years, you qualify as a first-time home buyer, which will give you the ability to put 3%. You also touched on a really important point that I probably did not address as fully as I should have. In community property states, like we are in, Texas is a community property state. So sometimes people confuse being on a mortgage with being titled on a home. If you're legally married and you purchase a home with your spouse, you might not be on that loan, but chances are you're signing that deed of trust, which means you're on that title. That's an important detail to understand, especially when determining whether or not you would fit the criteria of a first-time home buyer.
Since you mentioned that, can one purchase or be a co-borrower but not on the title?
No. Generally speaking, you can contribute towards down payment, assets, but as far as including income and credit worthiness in the qualification of a loan, you must be on that loan. And if you are on the loan, the title, the insurance, that's all got to match. Gotcha. So if it's Cory and Nell or whoever buying a house, title and the insurance, everything is matching.
Gotcha. Okay, good. What are the qualifications for a conventional loan? Key factors in determining, should I go government-backed FHA or should I go conventional?
There are minimal requirements, and then there is what is going to be more attractive. Your qualifications are going to vary. You might have fantastic credit, but your ratios might be on the higher side, or somebody might have 2 out of 3 great things. The assets are there, the credit's there, but there was a couple late payments 6-12 months ago that might not jive so well with AUS, which is automated underwriting. With a conventional loan, if you've got a 620 or better, you're more than likely going to meet those requirements, but it's going to vary based on the entire credit profile. More times than not, as far as attractiveness of pricing, once you get above the 680 to 690 score, conventional will start to really shine and look like a much better or money-saving opportunity in both the long and short term. Now, depending on the horse you're sitting on, you're going to have a different perspective. If somebody has more assets put away, is really focused on not having MI, maybe they're going to start by putting down the minimal amount, but they've got a nest egg or a war chest put away for the near future, where they say, okay, I'm going to buy this house. I'm just going to put the minimal amount down. I want to see what expenses might pop up, decorating, upgrades, etc. After a year or two, the plan is to pay down on my principal. That might mean that even though you had a lower score profile and FHA might have appeared to be a better pricing option, if that's the plan, a conventional might be the better route for you, because with FHA, if you're putting down less than 10%, regardless of how much you pay down that principal, you're still going to have MI. That makes sense? If you're on a conventional loan, your score might be 620 today, which might not have given you as low of an interest rate as with FHA. Right. But you might have $100 or $200 in MI monthly. Once you pay down that principal balance, things may change significantly with how that shapes your loan.
Right. Which is important to note, because these are the questions that you should be asking. If you don't know to ask those questions, then working with somebody who you trust to ask the questions on your behalf and to help you identify what's the best route you should go is very, very important, because this, of course, is the biggest piece to buying a home. Financial piece. How am I going to be paying for this? What product am I going to use? What resources do I have at my disposal to make this as seamless as possible and affordable given my financial situation, so that you're not going into it blind? Having these conversations is extremely key. If I'm looking to get approved for a conventional loan, what are the things that I must submit to you to start that process?
The required documentation is fairly universal, regardless of the loan type.
Let me ask this way. First, I'm a W-2 employee. And then secondly, I am a non-W-2 employee. I'm self-employed or I'm 1099. There you go. Answer it 2 different ways.
Okay, W-2 wage earner, it's pretty simple. We would need 2 most recent year's W-2s, your 2 most recent paycheck stubs, and your 2 most recent monthly account statements from which your down payment would be sourced. It's important to review those statements before you send them in and see if there's any significant interaction with any other accounts. What I mean by that is that if you are transferring large amounts of money from your checking to your savings, we would need to include those accounts to source any large transactions. Large is defined by 1% of your purchase price or 50% of your monthly qualifying income.
And outside of the stuff like your driver's license and things of that nature, Social Security, thus given on all applications, 1099 or self-employed, or what do they need to submit?
A 1099 or self-employed borrower, we need past 2 years complete tax returns, both personal and corporate if applicable. So if you're a sole proprietor, then everything's generally going to be done on one tax return. If you have a separate corporation, then you're probably filing both personal and corporate returns. So we would need the 2 most recent years. Now, with conventional, if you have been self-employed for 5 or more years, we can document that. We can qualify you based off of 1 year's tax return. The reason why that's important to understand is because on a 2-year tax return qualifying, we have to average those last 2 years of income, which sometimes can complicate things. A lot of self-employed borrowers are doing their best to minimize their tax implications. Sometimes that can make things difficult in qualifying for a loan. If you're planning ahead and are able to reduce the amount of write-offs, being able to use that 1 year's tax return makes it easier because then we don't have to average it with a previous year that might have been a lesser amount of income.
Yeah, when you are doing things to mitigate your tax payout, you want to deduct. And anything that's qualifying that you can deduct, I don't blame you, but it makes it somewhat difficult when it comes to getting funding for real estate the traditional route. If those things are not in order, then maybe you're pushing your clock a little bit further into the future to give that an opportunity to get in shape. Speaking and consulting with somebody like Eddie to make sure, hey, in the future, I may not be prepared now documentation wise. I got to get all that stuff in order, but 6 months from now, a year from now, or next quarter, whatever the case may be, tell me what you're going to need to see given my financial background as a self-employed person trying to buy a home. That way you'll have necessary steps that you need to put in place, working with the lender, so you're prepared for when it's time to go and get you a home, that you don't have to wait because you'll have everything submitted. And then that way you can also kind of like get your work checked. Like, hey, these are the things that I have. What do I need now? What do I need to show? Does this work? So when you're trying to qualify, especially if you go out and you find a home or rates have changed in your favor or anything that is going to make it a easier transaction for you financially, it's best to do what's necessary up front and have those conversations.
Right. That highlights why it can be so important to always check sooner than later. You and I have encountered this a few times in the past with deals we've been working together where somebody is putting their purchase plan a few months out, maybe 6, 12 months into the future. We have a brief discussion and they say, okay, I'm not going to get serious about this until next year because that's when I plan on purchasing. A year goes by, get into the meat potatoes of things, and we find out that there were some issues that we probably should have and could have addressed a year prior. So important. There are many aspects in qualifying for these different loan options. Sometimes, more than not, people will gravitate to one or two. Now, I'm focused on getting this year's tax returns right. I'm self-employed, so I want to make sure that I'm claiming as much net income as possible. That's all I need to work on without checking the credit. When we find out there were some things on the credit that we could have tuned up as well. Or maybe we're working on the credit and we failed to recognize something in the assets that needed to be addressed. Knowing where you stand sooner than later is key, especially when you've got time to plan and you say, okay, well, I'm not going to be doing this for the next 6 to 12 months. Then why not use these 6 to 12 months to address any and everything? So when the time does come to make that transaction, you've got your best foot forward and are qualifying for the best possible terms out there.
For sure. And this is where the buyer's consultation is very vital in uncovering and discovering what's necessary so that, one, your time isn't being wasted, and two, the lender's time isn't being wasted on things that can be uncovered so that we can really map out a real schedule of what we need to do. In the buyer's consultation, we're going to uncover a lot of the different things that I know Eddie is going to ask for. What's your financial makeup? How are you getting paid? How long have you been on your job? Salary, hourly, do you get paid 1099? That way, before we start looking at houses, we know we can get approved for a loan. In that buyer's consultation, a lot of what we just discussed is what's uncovered. The specifics are handed over to the lender so that you are able to find out what is going to be your buying power. A lot of people, especially first-time home buyers and some non-first-time home buyers, one of the biggest things is, hey, can I get some assistance on purchasing a home? Okay, I qualify for a conventional loan. Is there any financial assistance that I can get in the form of down payment that is available to me? And what are those things and how can it be coupled for somebody to receive down payment assistance?
There are many different down payment assistance options available that can work in conjunction with a conventional loan. Very high percentage of the time, you're going to see more FHA-related DPAs, and that has a lot to do with what we discussed earlier regarding the back-end ratios, giving you a bit more wiggle room.
Right.
Conventional loans do have, as a matter of fact, we got a great product, a 1% down conventional loan that gives you the ability to take advantage of a very low down payment of just 1% as opposed to the 3%. And you get all the other benefits that we mentioned earlier, where you might have MI, but if you've got decent credit, your MI could be minimal, significantly lower than the MI might be on an FHA loan. And as you continue to pay down and build the equity in your home, you have the ability to drop that MI without having to refinance. Whereas on an FHA loan, generally speaking, that MI is going to be forever.
Does down payment assistance impact your interest rate?
There's layers to that answer. More times than not, yes. But the program I just mentioned, the conventional DPA option, no. There's no hit to your interest rate. Now, there are income caps and stipulations that you need to fit into, which brings me to that broader answer. With down payment assistance, remember, it was originally designed for people that need assistance in buying a home. Most of the down payment assistance programs that might not have as much of a hit to your pricing or interest rate will have more stringent requirements in qualifying. Does that make sense?
Yeah.
Because of that, there's not going to be as many hits to the interest rate. As it gained popularity and people said, well, I want some assistance too. I make $100,000 a year or $200,000 a year, but I could use some assistance as well. A lot of lenders started to elaborate on those products. They said, okay, well, we're going to open this up to everyone. However, in order for your being able to access this program, you're going to pay a little bit of a premium. So in some cases, you might see a bit of an uptick in your interest rate. And this is across the board, but typically on your FHA DPAs, as opposed to most of the conventional down payment assistance programs that we have. I would imagine because there's less wiggle room on the DPAs and because of the requirements in qualifying for them, you're not going to see as many strings attached. With every program, there's going to be different requirements, but generally speaking, you're not going to see many hits to your pricing.
A lot of this stuff is I guess, borrower specific. If I'm a borrower, are there assistance programs available for me? How is it going to impact my loan, if at all? Is it something that is just going to be good for me? And I have to less money out of my pocket to close on a house. Getting one of these type of loans is fairly simple once your documentation is where it needs to be. Can I use a conventional loan to build a house? Can I renovate a home with a conventional loan?
Yes, we have construction loans that are conventional, renovation loans, essentially across the board financing. Both conventional and FHA in many cases can cover just about everything that you said. There's a VA construction loan as well. But our most popular construction or one-time close product, meaning you purchased your land and build on that land and we can do it all in one closing. The most popular is a conventional loan option that we use in those cases. So across the board, refinances, cash outs, if you want to pull some equity out of your home, all of these products are in the conventional lane.
We've discussed and touched on FHA, now conventional, and we look forward to the series continuing. Next thing we'll talk about is the VA loan, which is a very, very popular loan. We'll dive into some of the details of what it takes. Any last words on what you're seeing in your business as far as applications, and what are you seeing happening in the market?
People are beginning to accept our new normal this year over last year. We're getting a lot more applications. A lot of people are coming off the sidelines, coming from 2 and 3% interest rates a few years back. It was a shock for many people, especially people that weren't around last time rates were 6 to 8%. Now that they have sat there for a while, people are realizing homes are still being bought and sold, and I don't want to sit on the sidelines any longer. Rents continuing to go up, so people are getting in the game. A lot of times we may look into something with a certain plan in mind. The benefit to working with people like Cory and myself is we're going to always try to get you what you need. But if we see an opportunity outside of what you're asking for, we're going to include that as well. So you have a comparison. I get calls all the time with people that have 20% to put down. They say, well, I want to buy this house and I want to put 30% down. Heck, let's go ahead and put 50% down. I'm like, whoa. You're not really getting a benefit as far as your lower interest rate or anything. So let's take a look at this option, putting a lesser amount down, and we can still do that if you'd like. Unfortunately, the fact is there's plenty of people that are simply going to, oh, okay, this is what they asked for. This is what I'm going to give them, even though they know there might be a better option. And that's not the way we like to do business. We're always going to do our best. There's a reason you called us. We're going to do our job and make sure that you know all the opportunities that are accessible to you. And then you can make that educated decision on what you feel is going to be best. Because the last thing you want to do is get into a program or lock in a loan and then 2-3 years later realize, wait a second, I could have put less money down, had the same interest rate, and then paid down my principal and reformatted to have the same exact payment and save thousands of dollars in the process. Right. Those are the differences in working with us. We're going to show you those avenues.
I always look for an option for my borrowers to keep cash in their pocket. There are things that come up, there are expenses that happen, especially for somebody that's a first-time home buyer. You may have the cash, you've been saving it up, and you want to put it all in the house. But at that point, it's in the bricks. That is why the consultation with your realtor, the consultation with your lender is very important to explore those options and to understand, what do I have before me that is going to give me the best direction on making the best decision for me and my buying situation. That's what we want to give to you.
If you look back 5-10 years ago, most of us had completely different outlooks on life, finances, etc. Because as we grow, we're going to develop, change, and hopefully get better. When you're consulting with Cory and myself about such a huge investment, not only do we want to look at your current goals, but what is this going to look like in the future? What's this going to look like 5-10 years from now? You have some fix and flip people that might be buying a home, keeping it for 6 to 12 months, but that's not the majority. The majority of people that are purchasing homes are looking 3, 5, 10, 15, in some cases 30 or more years. So make sure that what it is you're getting today is catering for the long term. Because the market could improve and we could refinance. But if you were going to keep this loan for the duration for 15, 20, 30 years, what's that going to look like in the projected future? And that's what we show you.
Yep. So without further ado, man, I appreciate you, Eddie. And until next time, man, I hope this was impactful. I hope this answered some questions for people. But if it didn't and you have more questions, you can reach out to us. We're always looking to be led with value first, so that you can trust that what you're going to receive, whether you use us or not, is valuable information to help you in your process. So we appreciate y'all hanging in there today. And until next time, peace.
Thanks, everybody.